you use $10,000 for gold, let's say that silver goes to historical ratio gold-silver of about 15, $10,000 divided by 15, that is $666 for silver. That is a minimum, and I think we'll reach a lot higher than that. Don't hold any money in the bank. The banks probably won't survive, and the paper money will not survive either. Don't be afraid of buying more gold and silver here. You've got a fantastic opportunity, especially in silver, because it has had a bigger correction. Silver is the biggest problem market now in precious metals, LBMA in London. But it's not a physical market anymore. There are over 2 billion ounces of silver claims, more than 2 years production, and that silver just doesn't exist in physical form. There will not be any physical silver to deliver. The last drop that we saw on the 30th. The hedge funds have found a manipulative way of really cutting out these circuit breakers so they can set prices and price limits that circumvent the circuit breakers. And that's what they did on Friday. Don't trade in paper silver. Don't trade in ETFs. Buy physical gold, buy physical silver. We've seen quite a lot of excitement in gold and silver markets in the last few days. Friday, we had one of these quite violent, but I would say totally normal correction in a bull market and a bull market which has moved very fast. People have to remember that. Gold is up 86% since January 2025, and silver is up 155%. You have to bear that in mind when you look at these corrections, because both gold and silver are up massively in the last year. Now, just look at, for example, the Standard & Poor's against gold. If you look at that chart, gold is just bottomed against the Standard & Poor's index and has just turned up and broken now the downtrend and is in a clear uptrend. And that uptrend is a multi-annual uptrend. So we're going to see paper market losing massively against real markets or real commodities like gold and silver. I expect this to last many years, 5 years, 10 years, maybe longer. It's a new monetary era, and that will lead to the end of the present currencies as we know them. And of course, it will also lead to the end of the financial system as we know it.
This correction looks dramatic only if you ignore the scale of the move that came before it. Gold up 86% and silver up 155% since January 2025 is not speculation. It's capital reallocating away from financial assets, exactly as Egon von Greyerz has warned during late-stage monetary cycles. The S&P versus gold ratio quietly breaking down matters more than daily price swings because it signals long-duration underperformance of equities, not a short-term panic. Historically, these ratio reversals last years, not months, and they often coincide with deteriorating currency confidence rather than booming growth. This isn't about metals rising, it's about paper assets losing purchasing power in slow motion. What Egon von Greyerz points out next reframes why this trend could persist far longer than most portfolios are prepared for.
It's not going to totally finish, of course, but it will be totally different in a few years' time, be restructured because banks will have problems and many banks will fail. Sovereign bond markets will also collapse. Interest rates will go up to percentages that we saw in the 1970s, which is high teens, 20%, maybe even higher, and there'll be high inflation. Let's look at the fundamentals of the actual precious metals. As I pointed out at the beginning, the precious metals correction that we've seen now is a totally normal correction. And obviously the investors that have bought in the last couple of weeks, they're slightly down now, but gold, for example, is actually unchanged on the year, while silver is a bit down on the year, just marginally. So the move is so fast that we forget the price just a few weeks ago. But remember what I'm saying here, that is that gold and silver are in an era where they will go up by multiples from here. And, obviously, measuring it in paper currency like dollars or euros or yen doesn't give the true picture. That is not the real appreciation of the precious metals.
The overlooked risk here isn't metal volatility. It's the bond market stability investors still assume exists. As Egon von Greyerz has highlighted, sovereign debt today is far larger relative to GDP than in the 1970s, meaning high-teen interest rates would be structurally destabilizing, not merely inflation fighting. Gold being flat on the year while rates and deficits explode is not weakness, it's resilience under pressure. Investors focusing on short-term drawdowns miss that currency-based returns distort reality when purchasing power erodes faster than asset prices rise. The real danger His portfolios built on bonds and cash, assuming yesterday's stability, will return. What Egon von Greyerz explains next clarifies why paper returns can look positive even as real wealth quietly shrinks.
The real one is if you measure it in house prices or in cows or chickens, but nobody does. It's so convenient to use dollars. But investors should really not look at how much money they're making in dollars or how many dollars of metals they have. They should look at instead how much gold they own and how much silver they own and measure that in ounces or kilos or grams if you want. And that's a true measure rather than looking at a paper price, which is actually meaningless when the currency is being debased by the day. Now, we should have a look at the exchanges where actually silver and gold are traded. Comex in New York is a paper market. It's a fake market, or a false market at least, and their prices are being manipulated by big bullion banks and by hedge funds. Let's take, for example, the last drop that we saw on the 30th of December. This is the massive falls in gold and silver, and there are normally circuit breakers that stop the fall and freeze the market for 10 minutes for the market to recover. But the hedge funds have found a manipulative way of really cutting out these circuit breakers.
Dollar-based performance is comforting precisely because it hides what's being lost. As Egon von Greyerz often stresses, measuring wealth in ounces exposes the illusion. Currencies can rise nominally while collapsing in real terms. Comex pricing doesn't reflect physical scarcity. It reflects leverage, positioning, and algorithmic pressure from institutions that never intend to take delivery. When circuit breakers fail to activate during extreme moves, it raises uncomfortable questions about market design and who benefits from volatility. Retail investors see price, institutions see structure, and those are very different realities. What Egon von Greyerz points out next explains why paper price drops don't necessarily signal real supply easing at all.
So they can set prices and price limits that circumvent the circuit breakers. And that's what they did on Friday. So we never saw a 10-minute stop in the metals markets on Friday. Instead, we saw a 5-second stop that is hardly noticed. And this is the way that hedge funds can actually circumvent the circuit breakers and continue trading throughout the day and continue selling, which really is totally against the spirit of how the circuit breakers should work. But of course, hedge funds are more clever than whoever sets up the system. So if we look at Comex now, there is a massive shortage of both gold and silver, and massive shorts outstanding in the paper markets that can never be settled in physical. Remember, this is really only a paper market and was never meant for delivery. And now the market realizes there are not enough metals for delivery anyway. So this is why many participants now and many observers are actually looking at Comex potentially failing within the next few weeks or months. And that is a very high risk. Well, as we keep telling our clients, don't trade in paper gold.
When safeguards fail silently, it's usually by design, not accident. Egon von Greyerz has repeatedly warned that paper metal markets rely on confidence, not inventory, and Comex open interest still dwarfs registered physical supply by multiples. A system never built for delivery becomes dangerous once participants demand it, especially with record short positioning concentrated among a few players. This isn't market volatility, it's structural stress showing through the cracks. For investors, the lesson is simple. Price discovery breaks down long before headlines admit it. What Egon von Greyerz explains next highlights why paper exposure can unwind far faster than most expect.
Don't trade in paper silver. Don't trade in ETFs. Buy physical gold, buy physical silver, and keep it outside of the banking system in safe vaults where you yourself have direct access to your metals. That is the only way to preserve wealth and hold your metals. Now, going over to silver, silver is the biggest problem market now in precious metals. And physical silver is traded on the LBMA in London by LBMA banks in London. And that is a physical market. But it's not a physical market anymore. There are over 2 billion ounces of silver claims. That is 2 years production, or more than 2 years production. And that silver just doesn't exist in physical form. So if these paper holders ask for delivery, which they will do, there will not be any physical silver to deliver. And this is why there's a high likelihood that also the LBMA market in London will fail. So I want to come back to the fact that you have to expect now, as an investor in gold and silver, you have to expect much higher volatility. I said years ago that silver is not for widows and orphans because it moves very fast, and if you can't take the heat in the kitchen, you should stay out.
The real risk here isn't volatility. It's the illusion of ownership in markets built on promises instead of metal. As Egon von Greyerz has warned, the LBMA's silver market operates on claims that exceed physical supply by multiples, with estimates exceeding 2 billion ounces versus roughly 800 to 900 million ounces of annual mine production. That imbalance works only as long as holders don't demand delivery, which historically breaks down during inflationary stress cycles like the 1970s. ETFs and unallocated accounts shift counterparty risk back onto investors precisely when trust in financial intermediaries weakens. Volatility is simply the symptom. Structural leverage is the disease investors aren't shown on their statements. What Egon explains next reveals why this volatility may intensify rather than resolve.
But at the same time, silver is an incredible opportunity to get real returns on real assets here in the form of physical silver, because we expect silver to move a lot faster than gold. We started buying gold in 2002 for our clients and for ourselves at $300. We actually bought bigger amounts already then because we saw this end of the monetary era already at that time. And at the time I said that I expect gold to move to at least $10,000. It's not a firm target. It's just a round number that it is likely that gold will reach. So we're only just halfway there now, but we can move the next $5,000 very, very quickly. And if you take $10,000 gold, which is not the ultimate target in my view. We're going to move a lot higher because we're measuring it in paper money, and paper money is going to collapse much faster now at an exponential rate. But anyway, if we use $10,000 for gold, then let's say that silver goes to historical ratio gold-silver of about 15. $10,000 divided by 15, that is $666 for silver. That is a minimum, and I think we'll reach a lot higher than that.
Price targets matter less than the speed at which monetary confidence erodes. As Egon von Greyerz points out, gold's move from $300 to today wasn't driven by growth, but by debt expansion and currency dilution accelerating after 2008 and again post-2020. A gold-silver ratio compressing from 80 toward historical norms around 15 wouldn't be unprecedented. It happened in 1980 during inflationary stress. Silver's higher volatility is precisely why it outperforms late in monetary cycles, but that also magnifies drawdowns along the way. This isn't a straight line trade, it's a leverage play on systemic imbalance investors need to size carefully. What Egon highlights next reframes why ratios matter more than headline prices.
The ratio could easily go to 10, for example, and you take $10,000 divided by 10, you get $1,000. But it's not the point here that you're speculating to make money on gold and silver. And this is, as I said, really not real money, because a lot of it is inflationary money because the currencies are going down so fast. So you're holding gold and silver to protect yourself, your family, and to protect generational wealth against the end of a monetary era and the destruction of paper assets, and obviously including money. Don't hold any money in the bank. The banks probably won't survive, and the paper money will not survive either. So don't be afraid of buying more gold and silver here. You've got a fantastic opportunity, especially in silver, because it has had a bigger correction. So buy here, buy as much as you can afford, both gold and silver. Gold is the king of metals, but silver represents a fantastic opportunity. So for anyone who hasn't bought enough at this point, this is the time to buy, not be worried about the correction. Corrections gives you an opportunity which is unique right now, and therefore take advantage of that.
This isn't about chasing upside. It's about hedging survival risk most portfolios ignore. As Egon von Greyerz has consistently argued, bank deposits are unsecured loans to institutions whose balance sheets are loaded with sovereign debt risk, especially after 2020 era stimulus expansion. A gold-silver ratio near 10 would signal extreme monetary stress, not prosperity, similar to historical crisis peaks. Holding metals isn't anti-growth, It's insurance against systemic failure, where liquidity freezes and capital controls emerge. Corrections are emotionally difficult, but historically they've been the entry points that defined long-term wealth preservation. What Egon explains next shows how scarcity can override price entirely.
As Mr. Gold James Sinclair said a few years ago, he said, there will be a day when both gold and silver will go no offer. That means no one will offer you a price for gold and silver because there's such a shortage and you just can't get hold of it. So there's a bid, which means people want to buy it at a price, and there's no offer because there just isn't any physical silver or gold available.
And no offer isn't a metaphor. It's what happens when trust evaporates faster than supply can respond. As Egon von Greyerz has noted, markets price liquidity, not value. And during crises, liquidity disappears first, as seen in gold market freezes during 2008 and briefly in March 2020. A bid without an offer signals physical scarcity, overwhelming paper mechanisms, something futures markets are structurally unprepared for. At that point, price discovery fails and allocation replaces valuation. Investors waiting for confirmation often discover too late that availability mattered more than entry price,